Hello everyone and welcome to another Elliott Wave forecast video update. My name is Eric and today is the 18th of July around 3:22 p.m. Eastern Standard Time. Today we're going to take a deep look at the S&P 500 and we're going to mention why we believe that the S&P 500 reaching 10,000 within the next few years is completely in the table. Since 2009 crash in the indices, most of the traders has been bearish the indices, something that we in Elliott Wave forecast do not understand, but because it's going against human nature, but it's a reality. I mean, not everyone can be on the right side of the market, and everyone is entitled to their own opinion or analysis, but it's obvious the index is always going to be bullish, and it is obvious that yes, there's going to be correction, like the one between 2000 and 2009, the one during COVID, but in the indices the correction always is an opportunity to buy. Before we jump into the charts, I want to explain to all how Elliott Wave works, right? And this is the basics Elliott Wave advance in the theory. You got in the black degree 1, 2, 3, 4, 5. Then you got three ways put back, right? And then that 5 makes a 1 red, 2 red, and black. 1, 2, 3, 4, 5 and black make it 3 and red. So technically you got 5, 3 and 5 in black makes 1, 2, 3 and red. You make a 4 and red and another 5. After 5 wakes in red, you make the 1 in blue. So you got 3 degrees: the black, the red, and the blue. Each one is a 5 wakes advance. Another concept that I want to explain is what is called a nest. In a nest is a series of 1 degree, 2 degree, 3 degree, from higher to lesser degree, before the acceleration in the market take place. And in the 5, after the 5 wakes, for example in blue, it comes a decline in 3. So I believe that the S&P is bullish. I believe that it's in a stage in which it's giving traders the false idea that a crash is coming. But on the other hand, like we always say in Elliott Wave forecast, what everyone is expecting in trading, it never happens. I believe, like I say, that the S&P going to 10,000. And today I'm going to show you guys the path. This is the popular view on the S&P from the all-time low. Given this is zero line, right? And since zero line, this is the biggest correction. I understand there is an historic data that been put together with the S&P 500. But it doesn't matter. These are the biggest correction there, because in 1930s or the 1920s, the correction, the magnitude of the correction, it doesn't look like a magnitude of the correction of this magnitude, right? So let's assume it is 1 and 2 within the grand super cycle. Whatever correction happens before, within this cycle, it was corrected here. So this is your wave 2. You can say it is a flat with the marginal high here and 5 waves decline from 2000 to 2009. This is a peak in 2018, a possible flat with COVID decline here, and an advance from here and 1, 2, 3 waves. Regardless, if it's going to finish 5 weeks within the blue within the blue degree. Regardless if that's the case, it still needs from 2020 1, 2, 3, 4, and a 5. In other words, a little more upside. Elliott Wave was developed in 1920s or 1930s. The person that developed Mr. Elliott did not have tools like we have today. In Elliott Wave forecast, we have added a series of rules to the basis rules of the Elliott Wave theory. We say that the wave 3 cannot be the shortest, that wave 4 cannot penetrate, that wave 2 cannot be below the beginning of wave 1, and wave 4 cannot penetrate below wave 1. In other words, it has to. That's the rule. Those are the rules for an impulse, right? So, in some diagonal cases, wave 4 can touch the peak here, but cannot pass below wave 2 in a leading diagonal. So, if you want to be bearish, you can say, without hesitation, 1, 2, 3, 4, an extended wave 5 that still needs a 4 and a 5, and the market will crash. Like I said earlier, in Elliott Wave forecast, we have added tools to the system, to the theory. In our system, wave 5 needs to have divergency. And even when there is an extended wave 5, wave 3 needs to be stronger than wave 1. And then wave 5 can erase the divergency. If we put the RSI on this chart, what do we have? We have, this is the monthly chart. We have a market which is still, if you look over here, is 87, and here is 87.73. You can make the case that the rules there, it is all right. You got a high, a low, a high, a low, and high, and the RSI is showing a high, a low, a high, a highest low. It looks good. So that possibility, it can happen based on the angle. When you see this, it's like a 30 degrees angle. This one got, a little bit more vertical. It doesn't look like a wave 5. In our system, we use two tools, RSI and something that is called a stochastic RSI. The stochastic RSI in a wave 5, it needs a full reset in the 4. Of course, right here you don't see that. But if you upgrade the index to the highest degree, for example, like a year time frames, the stochastic is reset, is sitting at the highest. That's typical of a wave 3. You don't see, look at the low of the wave 2 here, you don't see any reset. On the yearly, on the quarterly, it's sitting at the highest. You're assuming the data comes here, the wave 2 reset, and the stochastic sitting at the highest. Even more, it's showing a cycle, a pullback, another cycle, another pullback, but always at the highest. Many traders, in their own way, identify that the stochastic is overbought as an opportunity to sell. On the other hand, in Elliott Wave forecast, this is nothing more than a bullish stochastic. So there is discount, and discounts, like I say, it has everything. Discount is, besides, let me explain something else. In Elliott Wave, there is a rule that say the rule of alternation. If this is a flat, wave 4 should not be a flat. And in this case, both looks like a flat. That supports the view that the market is nesting into a tremendous rally. And this is when it gets interesting. Because when I use the nest right here, I can see, like I say, a high, a low, a highest high, right? A highest high there. Then I see a highest high. I see a highest low, a highest high, a highest low, and the market is trending. Or is trading higher the stochastic or the RSI here. When I look at the yearly chart again, and I put the RSI, you can see how on the yearly time frame, these highs or this event this year, 2021, erased the divergence of 2020 and 2000, the peaks of the previous year, which is telling me that if this is the grand super cycle, that shouldn't happen. So I got the stochastic sitting at the highs in the yearly and the RSI erasing divergence. When you read the indicators, you always need to go from the highest time frame to the lowest time frame, because the less oscillation, the more reliable the indicator is. So in this case, I feel comfortable to say that the S&P is already into a wave 3 or wave 3, but on the monthly, I still got divergence here, which made me more inclined to the idea, which is that the index is within wave 1 here, or wave 1, or wave 3, or wave 3, or wave 3. In other words, that the index has a 4 nest. One nest, one cycle in blue, red, black, and is finishing the cycle in blue. We should be ending before the end of the year. If that being the case, this market is going to behave and is going to explode higher within the next few years. And when you add the math to this, this is when it comes interesting. If you do the extension between, if you do the extension between 1 in black and 2 in black, the 1.618 comes at 78.33. Wave 3 in black should be ending there. Then it should be a 3 in black, a 3 in blue. Sorry, it should wave 5 in blue ends over there, and consequently, it should be a 3 in black. With a 4 and a 5 to follow here, right? With a 4 and a 5 to follow. But after this cycle ends from 2020, you still need two more cycles of 4 and 5, one in blue, one in red, and that in that way, I can see easily, guys. I can see easily. I can see easily there, easily. The path that can take the S&P, look, this is almost 8,000. This high should be taken close to 8,500 or 9,000. And that's how the S&P is going to trade all the way up to 10,000 in the next few years. If we being honest, and I show you these two charts, look at this, look at the angle here, look at the angle, look at the angle, right? This one is the more vertical, right? Or if I show you this chart right here, and you look at this chart, what it looks like more. I believe, and I feel very comfortable that this is the count in the S&P. I haven't used here any market correlation with another world indices or the dollar or the yen pairs. But I think that the S&P has a lot of legs. Yes, we might see before the end of the year a pullback from around 61.72, but this thing is going to explode to the outside, and it's going to reach 10,000 within the next 10 years. That's my view. I stand for it. In an Elliott Wave forecast, we are not afraid to be wrong. I cannot tell our members to sell the S&P. Otherwise, I can be telling, holding your position, buy the S&P in any 3, 7, and 11, and you will be making money, right? So that's our video. If you like our video, join us here, and keep in mind, the S&P goes to 10,000. And I'm saying that on July 18 of 2024. See you guys around.